Congratulations on joining to Trading Campus! So today's lesson will be an introductory lesson about the market analysis, so candlesticks and trading patterns. Let's start with dynamics, how the price of the asset moves and how to use and analyze candlesticks in a trade. The movement of the chart, namely candlesticks, always obey the trend. So rising, bullish trend, descending, bearish trend, and of course sideways, flat. So what do candlesticks show? So each candlestick consists of two main parts. Body. It shows the opening and the closing price of the selected period. So up is green and down is red. And of course, shadow. So the upper shadow shows us the maximum price for the period, and the lower shadow shows us the minimum price of the chosen period. Meaning of candlesticks, so long body, it shows strong price movements into the direction of the trend. Short body or doji, it indicates the market indecision and trend reversal. Hammer, long lower shadow and a short body. So it shows upper reversal and vice versa. Trading patterns are repetitive figures on a price chart and candlestick patterns by which the trader identifies the future development of the price of the asset. Patterns are divided into two main groups, so continuation and reversal patterns. The most popular continuation patterns are flag and pennant. It usually shows us the continuation of the trend. Wedge can be ascending or descending. If the wedge is counter-trending, it usually shows the continuation of the trend. Triangle. There are symmetrical ascending and descending triangles. So if the price breaks through one of the sides of the triangle, so it means the continuation of the trend. First one, head and shoulders, our favorite. So it consists of three peaks. The middle one, which is higher than the two others, is head, and the lower ones are shoulders. So it usually shows the reversal of the uptrend. Second, double top and double bottom. Double top shows us two peaks higher and near each other, and of course downward trend reversal. And the double bottom shows us two low levels, which means upward reversal trend. The third pattern, triple top and triple bottom. It shows two lows in the same level with a reversal of the upside, which signals the reversal of the upside. It is nearly the same as double top and double bottom, but with three attempts to break through the level. The fourth, diamond, a rare pattern which signals a possible trend reversal. So how to find and use these patterns? For example, you can additionally use indicators, for example, RSI and MACD, to check the trend of the reversal patterns based on these indicators as well. So the work and the theory with these indicators will be discussed in our next lesson. Practice. So study patterns and don't forget to use your newly acquired knowledge into the market. So open the market, find the pattern that you just learned and put it into practice and make your profits. Remember that no signal patterns guarantees you 100% of accuracy. So it is really important to consider the market context, volume, and the fundamentals.